15%. That is the tax most concessional super pays. Outside super, a lot of people pay 30 cents in the dollar. That gap is why super is a locked box with a tax break. This is part 2 of the Australian Super series, How Super is Taxed, the $32,500 concessional cap from the 1st of July 2026, and a worked example on an $80,000 salary. General information only, not personal financial advice. Check ato.gov.au or moneysmart.gov.au for your situation. 2 buckets. Remember them. Concessional is before tax money. Your employer's 12%. Salary sacrifice. Personal contributions you claim as a deduction. The fund takes 15% tax on that. That is contributions tax. You do not get an invoice. It comes off the contribution. Non-concessional is after-tax money. You already paid income tax on your wage. The fund does not tax it again, unless you go over the after-tax cap. Give your fund your tax file number. Without it they can take extra tax, and government top-ups can bounce. Worked example. This year you earn $80,000 in ordinary hours pay plus super. No overtime. Qualifying earnings are $80,000. 12% is $9,600. That is your super guarantee for the year. If you are paid fortnightly, $9,600 divided by 26 is about $369 of super each payday. Weekly, about $185. From the 1st of July 2026, that should reach your fund within 7 business days of payday. Payday super, from Part 1. Same $9,600. Just smaller, more often. The fund then takes 15% contributions tax. 15% of $9,600 is $1,440. What actually lands in your account, before fees, insurance and earnings, is $8,160. If that same $9,600 had been paid to you as extra wage, and you were in the 30-cent bracket, the tax bite would have been closer to $2,880, plus Medicare. Super took $1,440. That is the deal. You cannot spend it yet. You pay less tax. This example is plus super, how most awards work. If your contract is inclusive of super, the 12% comes out of the $80,000, and the dollars are smaller. Check your contract. That $9,600 still counts toward your concessional cap. The cap is $32,500 this year, 2026-27. Last year it was $30,000. Indexed. So after your employer's 12% you have $22,900 of room, if you want to add extra before tax. The cap is one cap across all your funds. Employer super, salary sacrifice, deductible personal contributions, they all sit in the same $32,500. Payday super does not give you a bigger cap. It just pays the same super guarantee more often. You can see concessional contributions in ATO online through My Governor, do not guess. If you have 2 jobs, add both employers together before you salary sacrifice. Go over $32,500 and the extra is added to your taxable income and taxed at your marginal rate, with a 15% offset for tax the fund already paid. You can ask the ATO to release some of the excess from super. Leave it in and it can also chew your after-tax cap. Do not treat $32,500 as a target you smash. High earners. If your income plus concessional contributions is over $250,000, Division 293 can add another 15% on some of those contributions. The extra tax is 15% of the lesser of two numbers, how far you are over 250,000, or your concessional contributions. That can take the rate to 30%. Still usually cheaper than the top income tax rate. Most people watching this are not there. Low earners. If you earn $37,000 or less, the government may refund that 15% contributions tax back into your super. That is the low-income super tax offset, up to $500. You do not apply. Lodge and keep your tax file number with the fund. On 37,000 plus super, 12% is 4,440. 15% of that is 666, so the low-income super tax offset pays the $500 maximum into the fund. After-tax extra is the other bucket. The non-concessional cap is $130,000 this year, up from $120,000. If your total super was $2.1 million or more on the 30th of June 2026, that cap is zero. Under 75, some people can bring forward up to 3 years, $390,000, if their balance is under $1.84 million. Check ato.gov.au before you move that kind of money. Employers also stop owing the 12% once your qualifying earnings hit $270,830 this year. That is a high earner ceiling. It exists so compulsory super does not blow the concessional cap on its own. What the fund earns on your money is taxed at up to 15% while you are still building, accumulation phase. Interest, dividends, other investment income. In retirement phase, earnings can be tax-free, up to a cap. Transition to retirement still pays earnings tax until you retire or turn 65. From age 60, withdrawals from a taxed fund are usually tax-free once you can access it. Access rules are Part 4. If you salary sacrificed an extra $5,000 on that $80,000, the $5,000 is concessional too. The fund takes $750. You have used $14,600 of the $32,500 cap. You still have room. How you add extra, salary sacrifice versus a personal deductible contribution, catch-up, spouse, first home, is Part 4. 15% on earnings, year after year, still usually beats paying your marginal rate on the same investments outside. Fees can eat that advantage. Choosing a cheaper fund first can matter more than stuffing extra into a high-fee account. That is Part 3. Quick recap. 15% on concessional. Up to 15% on earnings. Cap this year $32,500. After-tax cap $130,000. Extra 15% if you are over $250,000. On $80,000 plus super, your boss puts in $9,600, the fund keeps $1,440, you see about $8,160 before fees. Next, Part 3, choosing a fund, fees, insurance, and finding lost super. Subscribe. Playlist is in the description.